friends, welcome to the Financial Literacy. It is brought to you by the Financial Literacy Foundation in partnership with Mana TV. Thank you very much for joining us this evening. We really appreciate your commitment into this. I hope that you are learning something and you are able to implement these nuggets. These are things that if we make use, we can turn out to be better stewards of our finances. We can turn out to be better managers. And as we do manage well the very little that we are having, we are in a position to can be trusted with even more. So thank you for your diligence. Thank you for your discipline in coming to stand with us. Great thanks and appreciation goes to our senior pastor, Pastor Joylene. Mama, thank you very much for heeding your call and calling us on board to come and stand with you. Thank you very much, woman of God, for the opportunity that you are giving us to be able to advance the work that has been laid in our lives. And big thanks also to our General Overseer, Pastor Strike, who is also behind the scenes at the technical level, making sure that things do happen. And thank you very much. May God richly bless you. May He enlarge your territories in the name of Jesus. Friends, we are today on lesson 25, which is the third lesson of the credit agreements that we have started 2 weeks back. This is the third week where we are talking about the credit agreements. We did speak about the different credit agreements that are out there, which we are making use of. And I did say that for us to be talking about this is so that we are able to understand these different kinds of agreements so that we can be able to use them properly to our advantage, so that we can be able to use the right facility for the right purpose, and we make sure and we are careful to ensure that they indeed become tools that we can use to grow ourselves, tools that we can use to grow our wealth, to grow our assets. And I believe that we are in the right direction where we can be able to do better with the little that we are having. Pastor Joylene once preached not very long ago and say, what you have is a test. And I want to assure you that indeed what you are having today, it's a test. So let us make sure that we pass this test with flying colors. When we closed last week, we were having just started with the last 2 credit agreements which we are having, and that being the vehicle finance and the mortgage bond. So today I would like us to kickstart again where we left over last year on motor vehicle, which is a vehicle finance. I said there are a few things that we need to learn when it comes to vehicle finance and motor vehicle finance agreements that are there. You know, this is important because cars are the second most expensive or the second most biggest thing after a property, after our houses that we buy. So things that we buy, it's your houses that is usually the most high valued thing in your life, and the second biggest will tend to be vehicles. And it is important, friends, maybe to also remind one another that both these 2 assets are very important in our lives. But the other one is an appreciating asset, the other one is a depreciating asset. And it is also important maybe to say that it will even do you good, my friend, to try and ensure that upon considering the buying of these things, the first that you may consider to have before the other will be that which is the appreciating asset, which is the property. Because as you have the property, you are already on your way to building assets, which will be growing, and you can also be able to use that very property to leverage against your negotiation on your agreement or on your financing arrangement when you buy their vehicle on the next time. So vehicle finance, it's also part of the medium-term financing arrangements, whereby interest rates that are charged are above the repo rate, are above the bank rates that we will normally know and hear about. And let me say also that there's nothing wrong with buying a car cash. In fact, it is good. But if you have saved such cash, and when you have saved such cash and you have enough to can buy such a vehicle of your choice or a vehicle of your dream cash, I want you to do one more exercise before you decide on whether you are going to buy that vehicle cash or not. I want you to compare the interest rate that you will normally earn have you continued investing that money, so that you can compare it with the interest rate that you will be charged if you were to go for vehicle finance. So in other words, it is not all to decide that I'm going to buy a car and I'm going to buy it cash, because as we say, cash is king. You need to have cash to be able to leverage even on negotiations, in arrangements and everything else. So consider whether it will be worthwhile for you to buy such to use such a lump sum to buy the car cash, or it will be better off if you have invested that lump sum and you go for vehicle finance. We compare the interest rates that are being charged in that. Going on, understanding the vehicle finance agreement, let me also say that for those who are having car allowances in as part of their remuneration or as part of their package, let me remind you that it is not a must for you to be paying in deposit. Yes, you can do, it is good, but you must not sit and frown in that I did not save enough to be able to pay a 10% deposit. It's not always compulsory to pay deposit when you are on a vehicle allowance kind of remuneration. This also goes with the self-employed people. When you buy a car for business purposes, for trade, that is how we put it. When you buy a vehicle for trade, it is not compulsory for you to be paying in a deposit when you buy such a vehicle. Also, if you are buying your vehicle for trade, in other words, you are in business or your job requires moving from one point to another, business trips, you must also remember that there is a very good tax advantage that you must always strive to enjoy, which is a deduction against your tax when it comes to the two things that we will associate with such. First, it's the value of the vehicle, the cash price of the vehicle when it is still new. And the other thing, it's the actual expenses that you have incurred. This includes kilometers travel, and it includes the fuel that you have purchased. It includes all toll gate, licensing disc fees, and all of that, excluding the tickets. But all the other things that are associated with owning a vehicle, those things can be deducted against your tax. So make sure that you keep good records when it comes to your vehicle usage, the cost that you incur, and all those other things. And some of the insurance companies these days, they are able to do a logbook for you automatically. By click of a button, you could be able to get your logbook for the a period. It could be for the whole past 12 months, it could be for 6 months, it could be for 1 month, but you are able to get a logbook without having to sit down. Each and every trip you have to sit down and writing opening kilometers and closing kilometers and so on. But in the absence of such insurance policy which is able to keep a record for you, you need to be recording down your kilometers traveled for business, so that you can be able to enjoy such tax breaks or tax advantages. As we buy vehicles, one of the facility in a finance agreement, it's what we call a residual value or balloon. So when you buy a vehicle, you are allowed to can be able to finance not the whole 100% of the purchase price, but you can finance only up to 60%. In other words, balloon, it's allowed to be up to 40% of the value of the car. So these are rules that are allowed in your structuring of the agreement. So can include the balloon or can include the residual. My advice to you is, if you are buying with a balloon or making use of a residual, you must be sure that you will keep that vehicle for a longer period, because should you want to change that vehicle in a short space of time and you have made use of balloon arrangements when you finance, it could be very difficult to carry over that additional amount, that 30% or that 40% that you did not finance, because it means you have to deal with it at the time of disposing your current vehicle. So you must be prepared to refinance the balloon at the end of the term. In other words, when you buy a vehicle, someone once came and said, I finished paying off my car, but they are saying that there is a balloon payment that I must pay and they want a lump sum. The rule says it's a lump sum, yes, but that lump sum you can finance. My point here is that you must know that if you are buying a vehicle with a balloon, that balloon needs to be paid. It is not a discount in the vehicle. It is not an amount to never be paid, but it's a money that you will still need to pay. It actually supposed to come as the last installment. Hence, we call it a balloon. So that lump sum must be paid in with your last installment. And if you don't have that lump sum, you can refinance. Even though the refinancing terms might be coming up with a bit a higher interest rates, but if you have used that, you need to know that you can refinance that. So it is something that we need to understand. So when we have used a balloon, it's either you are ready to refinance or you are over and above should you have to change the vehicle quicker or sooner. So you must be sure that you're gonna keep that vehicle for quite a reasonable period where you'll be able to refinance it and be able to continue with it further. One of the arrangements in the vehicle finance is the term of the agreement. You are allowed to structure your finance to 60 months or longer, even up to 72 months. 72 months, it will be 6 years. So you must know that you are buying a vehicle here, you are not buying a house. So I will suggest to you that even though you are allowed to finance even up to 72 months, just remember that the shorter the period your finance agreement will be, the shorter or the smaller the interest that you will have paid at the end of the day. So the longer the term of your agreement, the more interest that you will be charged, because the period is longer. So I will suggest that consider making use of the 60 months, which is a fairly reasonable term in vehicle finance. But other things that we need to understand, it's with regard to the settlement of the contract. So when you have been paying and all of a sudden you decide that maybe I want to change the vehicle or I want to pay off the contract or whatever that causes you to want to get rid of the contract, remember that the settlement value is different from the balance owing. Settlement value is always less than the balance owing. So when you plan to settle, remember that you can ask the finance house to give you a settlement figure. When you request a settlement figure, it's not a must that you must settle. So you may receive a settlement figure today, but you choose not to settle, or you decide not to settle, or whatever you were hoping to do to be able to settle, it is no longer forthcoming. I request my settlement figures probably on an every 3 months basis, just for me to be able to see what is happening in my account, because you must also be able to get used to requesting your account history, where you are able to see your installments coming into the account, the admin fees that are coming out of the account, and the interest and everything that gets charged in your account. Get used to that habit where you are able to observe all of that. It will help you a lot because you will be able to pick up some errors should there be any error. Human errors happen. Even when it is computers doing things, computers can also make errors because they are programmed by human beings. So it could be erroneously programmed where it comes to the calculations. So remember that when you request settlement, you are reducing some of the interest that you could continue to be paying further down the line, and they take it off because you are planning to settle now. So look for settlement figures. And settlement, like I said, it is not compulsory for one that if you have requested a settlement quotation, you must settle. It is up to you to can settle if you want to, and you can leave it if you don't want to, or if you are not able to, according to what we have said. The other thing we could talk with regard to the repayments and the settlement is that if you are paying the highest installment, so in other words, you went to a dealer and say, I want this car, and then they say this is the installment that you are paying, and that is the highest level of installment in terms of affordability or repayment terms. Remember that should interest rate go high, you are likely to struggle, because as interest rate go high, if you are on an agreement where you are not on a fixed interest, in other words, you are on a linked rate. Linked rate, we said last week that it is where you are on a variable rate, which is dependent on the changes of the interest rate in the economy. So if you are on a variable rate, when interest rate go high, when the Reserve Bank increases the interest rates and your bank increases the rate, it is likely to throw you off the line, because you might find that it becomes even more expensive for you to continue with such. So be careful, friends. When you buy a vehicle, don't always go for the maximum allowable or maximum calculated installments, because you must be able to build a cushion. Because if you don't do that, remember, unlike your personal loans and the credit cards and so on, this vehicle finance, the medium-term agreement, when you default, when you fail to pay, they simply come and repossess that particular asset which they have financed. So they always have the right, because the agreement or the credit or the loan is linked to the particular asset that you are buying, and it happened to be the vehicle. Remember that the installment that you are paying, it includes interest rates. It includes the interest charges. So in other words, interest is charged upfront. Unlike in property, for instance, where interest is charged differently. With vehicle finance, interest is charged upfront, and it is calculated as a total amount which will be paid, and then you are given the monthly repayment, which includes the interest and the capital. By so saying, I also want to say it may not necessarily work at your advantage to be paying 100 Rand more on your vehicle finance, because it will not change the interest. Yes, you might reduce the term, but very, very insignificantly. So don't be looking at that. My advice to you is that if you do have an additional 100 Rand that you can pay, look at some other level of debt. If you decide to put it in your vehicle, which is good, it will be considered as upfront payment, but not necessarily working to your advantage in terms of interest. Hear me and hear me well. I'm not saying it is not a good thing to be paying additional amount on your vehicle finance. I am saying additional amount may not help you when it comes to the interest charges, because it will not change much. It might change, even maybe reduce by 1 month when it comes to the original term that you have. So when you consider buying a car, friends, first determine your most affordable installment that you will be comfortable to pay. I said be on a look for higher interest rate going up after you have financed your vehicle. So be on a caution. Have a cushion which will be able to comfort you should the road becomes bumpy along the way. But remember that don't only look at the most affordable installment that you will be willing to pay. Also consider the insurance premium that you will be paying, because when you buy a vehicle, remember it must be financed. Sorry, it must be insured, because the finance house will also have it as a condition that this vehicle must be insured at all times. So we are able to calculate insurance premiums for you even before you buy. So if you've got 2 or 3 choices of vehicles that you want to buy, consider what are the possible premiums on your insurance for all those 3 vehicles. There are some of the vehicles, their insurance are quite high, and some of the vehicles, their insurance premiums are quite low for the same person because of the level of risk associated with that particular vehicle. Friends, I guess you have heard enough when it comes to vehicle finance. More we shall talk about some other time. Let me quickly, with the few minutes left, talk about the other remaining credit facility. We call this a long-term finance. Long-term finance for a property, for fixed or immovable property. I'm talking about a mortgage bond now. So purchasing a residential home is usually the largest a transaction you will ever sign for, like I said earlier. So during your lifetime, we can count how many big transactions you are likely to sign, and property is one of them, and vehicle finance is one of them. So let's learn to build all the other things so that they don't only become these only 2. So mortgage bond is the method we use to apply for credit to buy a immovable property. So the debt itself is secured by the property that you are being financed. So some of us, we are renting where we are staying. So, but the point that, the rent that you are paying could have afforded you perhaps to buy your own property. What am I saying? I'm saying if you are renting, don't be having this attitude that bond, I will never get into a bond. I rather build for myself and so on, while you are paying a whole lot of money in rental. It will do you good to simply apply for a bond and get into your own property. As time goes, remember, unless if interest rate changes, your bond installment will remain the same. So 3, 4, 5 years down the line, you will be very used to that installment. Hopefully, your salary will have increased also. So as a percentage, your bond is becoming smaller and smaller, and you are building equity on the property. So it is attitude thing. Some of us, we will not be able to create wealth if we do not borrow. So we can borrow in order to create wealth. So let us do it wisely. But what else to know? Interest rates here are calculated based on the outstanding balance. So on mortgage bond, unlike in vehicles and many other facilities we spoke about, on mortgage bond, interest rate is charged daily on the outstanding balance of your bond, and it is calculated or capitalized monthly. So avoid having your home loan, your home insurance, the building insurance to be charged against your bond, because every time that premium comes into your account, it is increasing your outstanding balance for that particular day. When interest rate gets charged, you are actually paying interest rate on the insurance premium that you have incurred. So watch out on this particular area. I will urge you to go and draw out your home loan accounts history to see what goes in, just like we said in the vehicle, what goes into your account. If your insurance premium is one of those things. Go and request that to be removed from the bond so that you can pay that separately. In any case, you are paying for it. It's just the smart way of the bank to be able to be assured that you will keep that insurance. So besides the property price that you buy, what are the other things that we need to be looking at? There are other things that we need to be considering. So besides the 600,000 price that I'm charged for the property, there are a number of other costs that are associated with buying and owning a property. Next week when we come back, we're gonna be starting on that and be able to demystify these things, because it is a season, friends. It is time that we must consider property and property investment as another form of growing wealth. We must consider those of us who are renting. We must go back to our drawing board and find out, is it really necessary? Am I renting because the bank can't trust me? The bank can't finance me? Or am I renting because I did not understand that I can qualify to buy a property? And with those many words, friends, I want to thank you for being with us today. And I want to give you to challenge you. Go and start looking at property out there. Go and start looking. Just as much as we are easy to go out and buy vehicles, we can also go out and buy property. Why can we buy 2-3 vehicles in our lifetime, and we can't buy 2-3 properties in our lifetime? It is possible. It is a similar thing, similar processes that take place. Both assets are financed, and the assets being purchased becomes the security for the facility. Thank you very much, friends, and may you increase from where you are. May you see the wisdom in what we are talking about. May God richly bless you in Jesus' name. Amen.